What does diversification really mean? Welcome to Tea at Taxevity, where you get insights from insiders, our many clients and collaborators. Today we're talking about diversification. I'm Pramod Sharma, your actuary at Taxevity Insurance, where we transfer financial risks with life and health insurance. We have a guest. Who are you and what do you do when you're not being interviewed?
Hi, Pramod. My name is Ryan McNerney, and I'm an investment counselor based in Toronto with a firm called Connor, Clark & Lunn Private Capital. And when I'm not being interviewed, I service many families, individuals, and non-for-profit corporations in helping them preserve and grow their hard-earned capital.
Okay, perfect. We're talking about diversification. To get started, what is diversification?
So in the context of a portfolio, diversification really means eliminating concentration risk, meaning having multiple investments that behave in different ways so you can manage and mitigate some of the volatility or the ebbs and flows that you see on a daily basis in the public market. It's very simply, diversity means holding a basket of securities as opposed to holding only a select few number of securities to, again, mitigate that volatility risk.
Okay, so you're putting your financial eggs in different baskets.
That's correct, and it's important that those baskets behave in different ways as well, which I can talk about as well. But yeah, you're trying to eliminate having too much capital in one concentrated basket, so therefore you don't live and die by just the movements of that individual security or that individual investment.
Okay, now there's talk about correlation of investments. Does that tie in with diversity?
It does. So correlation is really how we construct portfolios around diversification, and it's on a spectrum really. So correlation really defined between -1 and +1. On the higher end of that spectrum at +1, that correlation relates to two investments moving in the same direction at the same time based on the same type of information. So it is to think of two Canadian financial companies or two banks that trade on the same news based on similar market movements. So they have a positive correlation and a positive relationship. On the opposite side of the spectrum is negative correlation, or where we go to -1. That means two companies or two investments will move in opposite directions based on the same type of information or varying information within each of their sectors. So two investments that could be negatively correlated or have lower correlation would be an example of stocks and bonds. They don't move in the same way, and they often move based on different types of information. In the middle, we have zero correlation, and that's really completely random. So it's not positive or negative. It doesn't move in lockstep in a positive or negative way. Rather, it's completely random, and it's a random relationship.
Okay, so in a well-diversified portfolio, what would the correlation typically be that you're looking for?
Yeah, so it's hard to define correlation of a portfolio because correlation is a measure used to calculate the relationship between multiple securities. So as you add securities or investments to your portfolio, it's important that you look at what the correlation or the relationship of those two securities. Meaning, if you hold 10 different stocks, let's say within your portfolio, and they're all in the same sector, let's say financials in Canada, they're going to move in a very similar way on the same information. Rather, if you own 5 financial companies and you own 5 consumer staple companies and maybe some energy or grocery chains, those names are going to behave and move differently, and the relationship isn't going to be 100% positive, moving away from that +1 correlation. So when you add different things that move and behave in different ways, then that's how you diversify the portfolio.
Okay, and how does diversification affect investment results?
Yeah, so it's one of two things. So what you're doing when you're diversifying your portfolio is you're trying to manage that volatility, that risk within your portfolio, that roller coaster of the ebbs and flows. And again, if you have no diversity, then again, you live and die by the movement of that one investment or a small group of investments that behave in the same way. But when you can diversify your portfolio and manage some of that risk, what you're doing is you're not eliminating the growth potential if you're doing it properly. Rather, you're just putting a bit of a floor on some of the volatility within the downside of the portfolio, or the downside in weak markets. And that's really the meaning and the true nature of the diversification.
When I understood diversification years ago, it seemed to me that you don't invest only in Canada, you invest also in the US, and if you want to be a little more adventurous, in Europe and maybe even in the Far East.
Yeah.
Is that how you diversify today?
Yeah, that's a really good point. And even if we took a step further back, before the last 15 or 20 years, my experience has always been Canadian investors have always been very concentrated in Canada and North America. And at one point, there was a move to diversify those portfolios outside of Canada into those economies, into those global markets that you had mentioned, whether it be Asia or Europe. What we're finding now through technology, through globalization, through trade, is the world is becoming a smaller place, a tighter place, meaning the relationship between the Canadian market, US market, markets in Europe and Asia really all move in lockstep with each other, meaning there's that positive correlation or that positive relationship. So diversification now doesn't mean just based on geography. You can't only diversify as a Canadian investor by looking outside of that geography. So it really is adapting. And if we look at a lot of what we perceive, and I'll use air quotes here, as perceived smart money or smart capital, you know, we think of large pension plans, we think of Canada Pension Plan and Ontario Teachers and OMERS and HOOP. They've come to this realization as well. And over time, what they've done in working with diversity within their portfolios, adding complementary investments outside of the traditional market. So things like infrastructure or bricks and mortar real estate that again behave differently on the same information and really can change the volatility of a profile as well as the potential return of that portfolio as well.
Okay, so nowadays a key element is investing outside the stock markets.
That's correct. A growing portion of individual portfolios and larger institutional type portfolios is diversification outside the traditional market. And by traditional, what I refer to is the stock and bond market, and really diversifying into other things like infrastructure, private debt, real estate, things that many investors are doing and implementing now.
Is it possible to over-diversify?
It is. It certainly is. So, you know, think about the TSX as a market in Canada, and the TSX Composite has about 250 large names that trade within it, and these are all household names that all of us would know. If you were to diversify and own many of those names, say 150 or more, you could argue that you're over-diversified. You're owning essentially the entire market, and to your detriment. And I say to your detriment because you don't have as much growth potential, but you're absorbing all the volatility on the downside. Rather, if you can have a little bit more conviction, and instead of owning those 150 names, and if you only held between 30 and 50 names, you would still be diversified because it would be broken down between sector, between companies, again, that behave in different ways. But at the same time, you'd have more of an opportunity on the growth side because you have a little bit more conviction without giving up that diversity. So it really is possible to be over-diversified.
What about the opposite, concentration risk? Andrew Carnegie said that an approach is to put all your good eggs in one basket and then to watch that basket.
Yeah. It's a good point. You know, if you look at, again, I'll use the TSX as an example, and it's the Canadian index, but it's not very deep. It doesn't have a lot of breadth in terms of the sectors we can invest in. So energy and financials are a big part of the TSX composite in Canada. And if you were to concentrate your portfolio in Canadian stocks, what you would notice is you have a high degree or high allocation to Canadian banks, insurance companies, or oil sensitive or energy sensitive stocks or companies. This would be that concentration risk where, again, that portfolio lives and dies by the nature of those sectors alone. And therefore, you could, again, make a good argument that you're increasing the volatility of your portfolio if you're concentrated in a very select few companies or select few sectors.
How well do you think people understand the importance of diversification?
I think they understand it to a degree. And I say that again based on experience where I've had clients or partners define diversification as holding a number of stocks. But what's really important is not so much the number you own, but how the relationship between those stocks works with one another. Again, looking at the correlation of those two stocks or those two companies, the relationship in terms of how do they move in what direction based on the same information or based on the same dynamic of the economy. For example, an energy company may move based on the price of oil, whereas a grocery chain may not move with the price of oil, and therefore they don't move in the same direction and they have a little bit of negative correlation built in. So adding an energy company and, for example, a grocer would be a good way to diversify those two assets. But owning, two energy companies or two very cyclical companies, meaning they move in lockstep with the economic cycle through a growth or recessionary period, they wouldn't diversify that portfolio very much, or the holdings within the portfolio very much.
Okay, those are great points. Is there something else that we should talk about in the area of diversification?
Yeah, I would just reiterate that it's important that you understand how things move with one another. The portfolio construction process, not about only diversifying again by numbers or allocations, it's really understanding the relationship and adding investments that are true complements to what you already own or what you're looking to own in the future. So I would say if you're looking to diversify the portfolio, look at the relationship between the companies and the investments you own rather than just the number.
Okay, thank you for that. What's the best way for people to reach you, Ryan?
You can reach me directly at the office. My office line, 416-862-6309. You can also reach me directly over email, rmcnerney, no spaces, rmcnerney @cclgroup.com. Or you can always check out our website and see my profile there as well.
Thanks very much for being a guest.
Okay, thanks, Pramod.
Thanks to everyone for watching. That's the end of our episode.